The Nigerian National Petroleum Corporation sees the increase in global competition in the oil and gas space as an opportunity to intensify investments in the industry. The Group Managing Director, Mr. Mekanti Beru, at a meeting with the Society of Petroleum Engineers, explains strategies to ring-fence asset-based financing for the industry.
In the last 5 decades or so, Nigeria has depended solely on oil and gas revenues without focusing on developing other potential revenue-yielding sectors of the economy. This has exposed the economy to global oil price shocks and the avoidable diverse economic consequences, such as the recession we experienced a while ago. In today's fast-paced, dynamic world, Nigeria needs to leverage on her vast mineral wealth in terms of the 37 billion barrels of oil reserves and 199 trillion cubic feet of gas reserves, amongst others, to probe up other sectors of the economy and to promote import substitution in such areas as agriculture, manufacturing, and general services, etc. We need to be self-sufficient in at least the provision of basic needs and common services. The above submission presupposes that in the boom times, the country needs to save and also invest in critical sectors that will cushion the effect of times of economic shocks. In other words, Nigeria's fiscal and monetary policies, which are indexed to crude oil prices and thus cyclical in nature, may be unfavorable to the growth of the Nigerian economy in the long term. We need to look at the key sectors that contribute majorly to our gross domestic product and focus our energy on developing these sectors, albeit without killing or starving the oil and gas sector of investments, the goose that lays the golden egg. There is an emerging class of new producers who are primarily independents with a non-diversified portfolio and lean balance sheet, or the required track record to raise substantial funds. They have become important because approximately 15% of both oil reserve and national production lies in their hands. They also require substantial capital for growth. The Nigerian oil and gas landscape is fast changing from an IOC-dominated to a much more diversified cocktail of influences involving locals, independents, and the national oil company. Aside the disruptions we have witnessed onshore, the growth of the deepwater production sharing contracts has shown what we can achieve with safe environment and sustainable funding. We have witnessed over 2,000% production growth within the last 10 years, and production sharing contracts currently account for 41% of daily national production. It is also important that discussions take note and pay attention to the increasing global competition. The competition is in two ways: the new production centers across the globe, and particularly Africa, shale oil in the US, Argentina, and other places, and the competition in terms of the quality of crude oil. These portend new dimensions of the industry. Nigeria, therefore, needs to unlock new barrels as quickly as possible to stay relevant in the new emerging world. Without adequate funding, we cannot meet the targets we set. Let me make it clear, the government wants a self-funding and self-sustaining oil industry. Over the past 10 years, we have witnessed a 50% reduction in capital expenditure in the industry because of deferred projects, mainly due to funding. The JB underfunding has led to significant decline in JB production. As of today, measured against 2010 joint venture production baseline, we have a shortfall of over 550,000 barrels of oil per day, despite the best effort to augment from PSC and alternative funding financing, like modified carry arrangements and bank loans. We require incremental annual capital funding of a minimum of $7 billion to cover this gap and ensure growth. It was also clear to us that we cannot meet this funding gap without looking out, given the outlook of government expenditure and strategic focus. Alternative financing is therefore important to the sustenance of the industry. To turn the wheel of the industry and ensure that funding doesn't limit our growth, it is important we consider both the traditional and non-traditional funding options. Traditionally, we have raised funds utilizing equity or self-funding from cash flow, commercial debt instruments, or partner funding in form of carry or MCS. Other non-traditional funding options include contractual financing or deferred payment, pension funds sources, private equity sources, sovereign wealth funds, export credit agencies, and nonetheless, Islamic or Sharia finance. For traditional sources, equity and debt have their own unique challenges. Self-funding from cash flow is limited by availability of revenue, particularly during low oil prices. For debt market, the competition for funds poses a huge challenge. Banks' funding capacity is limited by country or sector limits, which may be unable to effectively fund all available projects simultaneously. Also, the decline in float for Nigerian banks, especially after the TSA mop-up or cap on lending to oil industry due to already high exposure to oil projects that are funded at high price and the need to maintain the obligo limits. This leads to the steady global shift from bank-led financing to non-bank and capital markets-based funding. The contractual financing model is predicated on the availability of spare or underutilized industry capacity and technical competence of service providers. Services are provided for future cash payment upon delivery of project. The funding is non-recourse and is based solely on the viability of the project and geological potentials. Other funding sources and other potentials are abound, as you could see on your slides. So, what have we done? At the NNPC, we recognize the challenge as well as the opportunity the underfunding has presented to us. The balance of objectives requires that we undertake a paradigm shift in our business model to ensure we attract capital and sustain flow of investment. Much more, the recent fiscal challenge experienced by the nation places a burden for change. Hence, we have undertaken to broaden the base of investment sources outside traditional government funding. We cannot meet this demand without the corresponding investments coupled with a structural shift in our investment pattern or model. Oil remains an essential building block for our economic growth, particularly as a developing country. Evolving new funding mechanisms for the joint venture operations was part of the focus of the reforms undertaken by government to eliminate the often difficult cash call regime, enhance efficiency of the management of the oil and gas resources, and guarantee growth. To encourage the existing players in the industry, particularly our traditional JV partners, we undertook to settle all outstanding cash call arrears amounting to a negotiated sum of $5 billion